He is the managing director and aerospace and defense analyst with RBC Capital Markets. Ken, thanks for being with us. Let me start with a stat that was in your note. The defense sector is trading at a PE of 19 times. That is a 5% premium to the market compared to an 11% discount with a 10-year average. So these are relatively expensive. Why buy them now?
Yeah. Hi, Deidre. Good afternoon. I mean, that's a great question, but I do think we are looking at a new reality here, and I'd highlight a number of reasons. One, just very tactically near term, if you're concerned about sort of broader economic pressure, these stocks tend to outperform in rising rate environments. You can get access to a sector that generates phenomenal cash flow, likely upside to estimates in 23 and 24. And then you've also got a sector, I think, that's going to benefit from fundamentals that are strengthening and not fully reflected in sentiment. So I do think it's a sector, to your point, that has had a great run this year. I do think there's more upside to come, especially with some of the stocks that are better positioned.
But Ken, if the economy is in for more pain, inflation remains high. So lawmakers have to have their eye on food prices and gas prices. Does the defense budget get cut? Is it intact? Where does it sort of rate among priorities?
I would argue that it rates relatively high. I think, one, the defense budget and defense spending in particular is a good way to put money back into the economy. I would argue that if you look at where the budget is today, you've got very broad-based political support for elevated defense spending, both across Democrats and Republicans. I think we're entering a period of modernization, specifically around some of the legacy nuclear programs that should drive some upside. So you've certainly got supply chain risk. Your point about inflation is obviously a key critical issue. These companies are facing higher costs. There's limits naturally to how much they can pass on. So companies under some firm fixed price contractual structures will face incremental headwinds. But ideally, as that normalizes, I think in the next couple of years, we're looking at low to mid single digit growth in real defense spending, which would be incrementally positive.
Plus capital returns, right? In a rising rate environment, shareholders love dividends and buybacks, and this is a sector that skews towards that, right, Ken? But also, there's talk of consolidation and more M&A activity. How should investors balance the two?
Yes, I think there's going to be limited consolidation at the prime contractor level. I think the Biden administration's been pretty clear that we shouldn't expect more of that. And to your point, you're right. These companies over the next 2 to 3 years likely return 100% of their free cash to shareholders, both through a mix of dividends and buybacks. So that should be incrementally positive and help provide a floor, certainly on valuations for these stocks. I do expect continued consolidation among some of the smaller companies, but I don't expect M&A to be a big use of capital. I expect a lot of it to get returned to shareholders.
And Ken, in your note, you also said that persistent China risk will support long-term sentiment and funding upside. But I wonder, is that short-term risk increasing as well this morning? I'm sure you saw the headlines. Taiwan vowing to counterattack if Chinese forces enter its territory amid military exercises around the island by China. Could this be a shorter-term catalyst, too?
It's possible. I mean, you certainly don't hope that we get more catalyst than we've seen. I do think a couple of things. I would say, one, near term, I think the situation in Eastern Europe has proven to be a lot more longer term, maybe problematic than I think we'd all expected 6 to 9 months ago. So that likely continues to provide a near-term catalyst. I think what you've seen initially is obviously a lot of the aid efforts and shipments by the United States have come out of existing inventory. So that's probably more of a 23, 24 story and upside for a lot of the companies. I think the situation with China, when you think about sort of near-peer threats and competition, whether it be up in space, whether it be cyber, whether it be certainly around Taiwan and in the sea, is not going to go away. I think that persists. Hopefully it doesn't get worse for obvious reasons, but I think it will continue to be in the background to some extent and continue to drive a focus on funding and national defense, which again elevates the defense budget.
Well, Ken, it was a good view of the sector. Thanks for being with us today.